Welcome to the Allocators podcast, where we go inside the minds of financial decision makers and their allocation priorities for 2023 and beyond. I'm your host, Sheret Ross. Hi, everyone, and thanks for joining us for the first episode of the Allocator podcast. Today, I'm joined by Juan Lopez, CFO of MycoWorks, a biotech company. Thanks for joining us, Juan. Great to have you here.
Super excited to be here.
Beautiful. Can you give us a bit of a background on your role, your experience in finance? That would be probably a good place to start.
Absolutely. So, as you said, I'm the CFO of MycoWorks, which is a biotech company focused on alternative materials. And I've been in the company in this role for the last 4 months. Prior to joining MycoWorks, I spent most of my career in 2 companies, right? One is Anheuser-Busch InBev, which is the largest brewery in the world, where I went through different financial roles from head of audit to CFO and CEO of the biotech business unit. And prior to AB InBev, my first company was General Electric, where I spent 10 years in different financial positions, including audit, M&A integration, as well as strategy. Looking forward to this chat, Sheret. Nice to meet you.
Yeah, you too. All right. Well, I have a list of questions I'm just kind of curious to get your perspective on. Really, the goal is to understand how you approach being a CFO of a company and understand how you think about capital allocation strategies. So just to kind of kick it off, how are you thinking about capital allocation for 2023, just given the economic climate that we're facing right now?
Yeah. So look, how I think about capital allocation is we need to think about it in a dynamic way. It's not something you set on January on a stone and then you just put it in a drawer and then everybody's going to follow it as robots, right? So we need to remain flexible, first of all, and you need to balance your capital allocation and align them with their priorities as they evolve, right? So to me, at this point in time, for sure, we need to think about paying down debt, right? If you have variable rate debt and that rate is going up, you need to allocate some money to reduce your cost of capital. You need to, of course, invest behind organic growth and the organic operation of your business. And then you always need to be having a look out for potential M&A, right? Is there any target company that could be interesting to acquire that gets to, that is in trouble due to the environment and could be a good target at a good price? So those are the 3 things in my mind. From a financial standpoint and an operational standpoint, of course, investing in the operation, investing in the organic growth is what takes most of my time. I'd say paying down the debt is a decision we make quarter over quarter, and we check with the board. We monitor that closely, of course, to make sure our cost of capital doesn't go too high. And then the M&A, it's based on, I'd say, ad hoc, right? It's based on opportunities that arise and given discussions I have with banks and other investors.
Are you seeing a lot more activity or opportunities available today than you were maybe a year ago, or has activity dropped off just given where market is at?
I see more coming, and I see a lot of banks approaching us saying, hey, would you be interested in acquiring this company or this other? So I see a lot of companies starting to be in trouble. There's less liquidity than, let's say, 12 months ago. The cost of capital is going higher. Investors are keeping their money on the sidelines, right? There's a lot of dry powder waiting to be deployed. And so I think there's more opportunity today, and I think there's going to be even more, right? As I think 2023 evolving, second half, there's going to be a lot of opportunity and activity happening in M&A.
Are you seeing, I'm less familiar with the biotech community, but are you seeing valuations remain strong, or are you seeing market multiples decline just given where the public market is?
Declining a lot. So as you saw in the public markets, 30-40% declines year on year is the norm. For biotech specifically in the private market, what I see is even larger drops, so up to 50-60%. We monitor our competitors and we monitor many other private companies, and we've seen big drops. Also because they were inflated, right? You see some unicorns that were $1.5 billion valuation a year, 2 years ago, that now are below $500 million. In our case, we've been lucky. We've raised 2 rounds. Well, one round early last year and a round extension, let's say, early this year with a small uptick on valuation. But I think it's because our valuation was pretty reasonable all the way through. We never really went up too much.
Just going back to your additional note on capital allocation. So debt is obviously a hot topic right now, just given where interest rates are. Is there a target that you're trying to get to from a capital structure standpoint, or is it one of those things where you're just reviewing it quarter over quarter and seeing where cash flow is at and taking it more opportunistically, or is there a target that you're trying to get to?
Yeah, I'm a big fan of having guardrails, right? So as I think about the maturity of a company, you need to have those guardrails evolve as well. So in a company like MycoWorks that is in early stages, let's say, scaling up and trying to make it, let's say, at a large commercial scale, we need to keep our debt pretty low, right? So I always say between 1 and 2x EBITDA, is the sweet spot. Anything higher than that, you are in red zone, because when an investor or a bank is going to look at your balance sheet, they're going to think this is too much debt, especially at the cost of capital and the rates how they are today, right? So I try to keep it between 1 and 2. I'd say closer to 1 if possible at this moment in time, and that's how I think about it, right? Obviously, we need to balance that with the liquidity and our cash flow needs, but I think so far we've been successful keeping it pretty low. When I think about larger companies, right, where I came from, I think it's always good to be between 2 and 3. So you have, you graduate to the next level, you can afford a bit more debt, because also you get better deals, better cost of capital due to your size, due to your credit rating, etc. So that's how I think about it, and that's what I've been executing with my team towards.
Have you seen banks and private lenders apply additional diligence requirements in order to qualify for certain levels of debt, or are the funds available for companies of your size?
No, the market is drying up big time. I'd say a lot of the credit that was available 6-9 months ago is going away, and the one is there available. It has many more covenants, much more scrutiny. You get grilled about what's your financial position and how you're going to pay that back, right? So yes, the answer is it's tougher today than 6-9 months ago for sure.
Yeah. Okay. So just to pivot to how you purchase or procure in the business today, would you be able to walk me through the last major supplier purchase you made at the company, and how did that process flow? Yeah.
So at MycoWorks, we're in the process of building our large-scale facility in South Carolina. So we're spending a significant amount of money. And so the largest purchases we'll be making are equipment purchases, right? So what we do is we basically start with engineering. We understand the equipment we need, be it robots or different types of equipment that we use in our process. We identify with our procurement team 2 or 3 suppliers that could be potential companies that we partnered with to procure this equipment, and then we enter in a negotiation, right? Typically we try to keep it to 2 to 3, because if you go more than that, you get too many and the process takes too long, right? So when we get there, we of course ask for requests for proposals. We try to negotiate all-in type of agreements where we negotiate the equipment purchase and equipment service installation and potentially the maintenance as well. And then we compare as a team, finance, engineering, and supply chain, and make a decision, right? So the latest one has been, some equipment from Korea that it's being installed actually next week already. So we've been lucky that we were able to procure that within, I think, a couple of months since we cut the PO.
And how would it usually work? Like usually you would have the budget or plan in place, and then you task procurement to go source vendors, or what's that flow look like?
Correct. So we have the budget in place. I'd say build it on an annual basis, right? For projects that are multi-year, we have the project budget defined in advance as well. And then we ask procurement, hey, within this budget, go find suppliers that could be within the range, right? Let's say 10-15% within that range maximum. I gotta tell you, we picked the worst year in history, I think, to build a factory, 2022, right, with all the COVID disruptions, inflation, I mean, you name it. So I'd say overall we've been able to keep the budget in check, but it's been super challenging, right? We've been reworking the plan, reworking, value engineering the whole plant, and in the end we're gonna be within budget and on time, but it's been really challenging.
And what was an effective tool that procurement used beyond, RFP to source vendors that could meet that budget? Was there anything specific that the company did?
For equipment specifically, no. Honestly, you cannot do things that you can do, for example, for commodities. For commodities, you typically could do a reverse auction or an e-auction that, you ask these vendors to beat their best numbers. For this equipment, honestly, it's very unique. There's not that many vendors that can do this, and so it was a bit tougher to do, right? It was more of a negotiation that, we said, this is our first large-scale facility. We have plans to build 3 more in the next 5 years. So if you come along with us and give us a good price, we'll get back to you with a larger order, right? This is, again, the first one. The next one is going to be a bit larger, and then the others will be even larger. That's our plan, right? So it's kind of putting the carrot ahead of them and telling them, hey, if you come along with us and we're successful, we will be coming back to you for more. In some of the large equipment as well, we put on the table potential, warrants or, stock-based compensation for some of the vendors as well to lower some of the cash needed as well. So that's a tool we used as well.
So you're giving out equity options as a means to compensate?
Small amounts. Yeah, small amounts of that. We got a bit, it may sound suboptimal, but in a way we said, look, if the company is successful, we will share some of the upside with you for some of the most expensive equipment. We've done some of that.
That's interesting. And so in that case, just given the limited number of vendors likely capable of producing the equipment that you require, what's kind of the view on RFP versus non-RFP? Like, I think this is a pretty hot topic right now in procurement. Are we able to, go direct to the 2 or 3 vendors that we know and directly negotiate and do kind of like a loose RFP, or are you seeing more full-blown RFPs in market today?
No, we've been, especially for the equipment that is very specific, we know exactly what we want. It's more the loose RFP, right? That's where we go to the 2 or 3. We have an informal chat. We send a very generic RFP, not very detailed, right? We want to optimize for speed and getting those quotes and being able to have discussions back and forth, rather than a super detailed RFP that gets them, get us a lot of detail and takes them a couple of months to do, right? So that's kind of what we've done for those. For the more commodity side, I'd say yes, we do a bit more of a specific RFP with more details, and we try to beat it out a little bit more. But yeah, for the equipment, it's a bit more loose.
Awesome. And so what are you valuing? I mean, beyond price, because obviously, in today's market, that's pretty critical. But is there any other elements in working with a supplier that you're looking for beyond price and technical capabilities?
Yeah, what we've been talking about is, for strategic suppliers, we want to partner with them, right? We want to grow with them, and we want to share the upside of what we're doing, right? We will be successful if they support us and they want to come along with us, right? And this applies to both equipment, but also the raw material side, the indirect side as well in some instances. So we've been trying to build partnerships for those suppliers we believe is worth doing and that we believe they can scale with us. So there's a handful of them. Again, this topic of equity or potential warrants is something we used not many times. It's not that something we do with every supplier, but a couple of them we've done, and they love that, right? And that's where we show them that we really want to partner. We put that on the table, and they really like it, and then they have a skin in the game to come along with us and make this a success.
Yeah, it's an interesting concept. I don't think I've ever heard of companies providing warrants to suppliers. So that's pretty innovative. So following from that, beyond this factory, because it sounds like this factory is a pretty critical function for the team right now. Is there anything else keeping you up at night that is top of mind?
Well, of course, I'm always with an eye on the bank accounts, looking at the cash balances. The one thing I'll tell you that it was a big opportunity that we took was improving and optimizing our cash management. As you know, interest rates are higher. That's bad for debt, but it's good for yield, right? So if you are able to invest and you have a large amount of cash and you can do sweep type of strategies where you move money around to high yield accounts like money market accounts or other like private debt or some maturity you can get in the short term that still gives you some liquidity, you can get a good like 4 or 5% return on that cash, right? And if you have a good amount of cash in your balance sheet, and again, if you manage it and schedule it very well, you can get quite a bit of return. So we've been very successful on that in the last couple of months. I'm super happy with how we executed, partnered with our bank and of course my team, and we're getting a very good return. I mean, this is going to be potentially an extra month runway. When I think about it a year or two out, if things continue to be like this and we continue to execute well, we'll extend our runway by a month just by being smart on our cash management.
I'm asking all our guests this, but if you had a crystal ball for next year, where do you think interest rates are going? Up, down, sideways?
For the next year, so I think we're going to see a couple of more hikes. Then it's going to stay flat for, I'd say, a couple of quarters. So I'd say we're going to end up the year near 6%, probably between 5.5 and 6. And then I think in 2024 we start to see interest rates going lower. So I'd say the long-term rate that we are using in our financial models to forecast the next 6-7 years, it's more 4 to 4.5%. The question is how fast is it going to drop, right? It's going to go down. But I think it's going to go higher before it goes down.
Yeah, that's interesting. Well, thank you, Juan, for joining us, sharing your insight. Appreciate the time today. This is Sheret Ross, and we'll see you next time on the Allocators podcast.
Excellent. Thank you.